All right, we've got the slides. Well, good morning, everyone, from my side as well. Can I just echo what was said, that this is the first live event that I've been at since probably Interlift 2019. So great to see quite a few familiar faces here, otherwise it's actually quite nerving and surprisingly so. I'm Andre Kukhnin. I head the European equity research team at Credit Suisse in London. I'll take a minute to explain what I do and why I'm here, and then we'll go through the actual presentation. What I do is equity research, which is trying to help portfolio managers that run our pension funds to pick the right stocks in a very specific capital goods industrial sector. And part of that is elevators, and that has become quite a specific area of research and almost a pet hobby of ours, that it's an industry that contains a lot of interesting companies. It's a structurally growing and attractive industry and is not very well researched, so it's something that we spent a lot of time on. And as part of it, we aim to build our industrial network, go to events like this, meet people like yourselves to learn more about the industry, so that we can be more informed in terms of telling the investors which companies to pick, and B, when things change, when events happen, and I don't need to tell you about the importance of some events that happened recently, then we're better equipped to respond to that, to spot the opportunities in the market. So why I'm here today is to talk to you about how we view the market, give you an update on recent developments, recent trends, give some idea on the outlook, how we think about it going forward, and talk about some key themes and our take on that. Obviously, my primary area of focus is the large OEMs. These are the kind of stock-listed companies. But for this presentation, we'll also try to think about through the supply chain, about independent service providers, and of course the supply chain in terms of the components and subsystems manufacturers, which I know many of you are present here and who I was very pleased to meet last night as well. So without further ado, we'll go into it. I've got the plan here. So we first talk about the end markets, so splitting into major groups, Europe, North America, focus on China. I'm sure there could be some questions about the recent developments there. I'll try to cover that and offer our view. And then we'll talk about the themes and debates, and then I was planning to do a bit of Q&A at the end, but actually what we'll do is just conclude with some remarks. So moving on to Europe and demand trends and outlook. And by the way, these slides are shareable. Material kind of behind them is shareable as well, so feel free to grab screens, but I'm also more than happy to provide the actual PowerPoint or PDF and most of the data behind them as well. Looking at Europe, if we take a big step back and think about kind of since great financial crisis, that market hasn't really changed a huge amount. We had a correction on GFC, then a bit of a mild growth, and we're broadly at a similar kind of level since the sort of bounce back post the great financial crisis. And what we've had is a very steadily growing maintenance base. So the chart on the top left is the new installations on the columns, and the red line is the installed base across EMEA here. When we zoom in a bit closer into the current trends, and that's the chart on the top right, where we think about the quarterly development, here we had a relatively resilient new equipment market during the COVID initial impact, during the lockdown. And bear in mind, these are the elevator orders for new equipment. So going down 10% really in the thick of it in early quarters of 2020, that would compare to maybe other buildings-related systems orders going down by easily as much as 30%. In some countries, these markets were down as much as 70. So even on the new equipment side, elevator market demonstrated clear resilience. If I were to overlay that with the maintenance revenues across Europe, then that is something that held up remarkably steady. In fact, flat or even continued to grow slightly, because in all European countries, maintenance was deemed as system critical and therefore could be performed through the pandemic. What we're seeing now is the bounce back. So we're recovering by that kind of similar high single-digit rate up to Q2 this year. We're going to have more reporting starting from tomorrow, actually, with Schindler, and we'll learn a bit more about the market development then. But we expect that kind of mid to high single-digit growth to remain for the second half of this year. And then for 2022 and beyond, it's the kind of box at the bottom left where we present firstly what the OEMs say about the market, but then our view for the more outer years, where it's 2 to 3% kind of steady growth for European market, given its degree of maturity. In terms of upside to that, if I really had to think about where we could be wrong, it really is from two things. One is the increasing elevator density, something that we actually discussed last night. In some countries where more buildings of low rise are becoming equipped with elevators, while the predecessors of those buildings were not. So the density of construction elevator density of construction is rising in some countries in Europe and has got potential for more. And second is the green stimulus, whether on new construction side, probably a bit more on the modernization side, where we'll talk about it in the context of the US as well, but the idea is that, okay, elevators are not the most energy consuming device in the building and therefore are not targeted for green investments such as HVAC, heating, ventilation, air conditioning, or glazing or other insulation. But if you're receiving funds to replace your HVAC system and at the same time you are changing the glazing, that is kind of the entire remodel of the building. And therefore elevators and other systems will be done as part of it. That's kind of our thesis. And then an extension of that would be to say, okay, well, if some buildings are doing that and renovating and becoming higher green standard, then what are their competitors going to do? The other buildings, they may well follow. And that is kind of the upside scenario to that 2 to 3%, which is our base case for Europe. Moving into North America, that shape of the market, when we take a step back, look kind of more over a decade back, is similar to Europe. We had a bit more of a pronounced downturn and a bit more of a recovery subsequently. Obviously, North American market is largely non-residential driven, so residential construction had a much more steep recovery in North America off a lower trough. And if we think about what we're seeing right now, that had a bit more of a pronounced new equipment orders impact during COVID. North America was arguably a bit slower to reopen on that side, and it's a bit of a deeper downturn, but now, almost as a function of that, is having a faster recovery that is yielding to all sorts of supply chain issues as well, which I'll touch on in a minute. So in terms of the outlook, the new equipment and modernization right now is seeing a bit of a bounce back in North America, so that is continuing into second half of this year. For this year, the growth rates of around 10% are anticipated. And then for the outer years, if we look at new equipment, we think 5% next year, 3% the year after are reasonable forecasts, looking at the lead indicators for non-residential construction, such as ABI, the Architects Billings Index, or Dodge Momentum Index, that tend to lead that by about a year or 18 months. And for maintenance and modernization, a similar kind of 3 to 4% outlook driven by install base growth and that modernization effect thanks to green stimulus. And again, when we think about the 2023, the outer years forecasts, that's where kind of the green stimulus probably presents most degree of upside for us. And if we look at green in North America compared to Europe, as percentage of total construction spend, it is substantially higher, the stimulus money that have been allocated. But in Europe, if we look at this sort of 72, 80 billion that have been talked about, that's barely 0.5% of an annual construction spend. So it really requires the knock-on effect, that kind of green stimulus, to become a catalyst for further spend as opposed to being an outright expander of the total market size. Moving on to China, that's kind of the picture if I put it together a month ago. So we'll come to the but, to the Evergrande and the recent developments on the next slide. Obviously, Chinese market is a structurally different one over the last decade. We've had a new equipment market growing 5 times from 2005 to 2015, becoming by far the largest market in the world, dwarfing everything else. Since 2015, we haven't grown. And I don't think many people realize that about China. I think people still think, oh, what if China doesn't grow? Well, it hasn't for the last 5 years. That's the new equipment orders. I know there are different schools of thought in terms of sizes of the market, and there are some numbers out there that are kind of 2 times of this size. We kind of tend to go with these estimates that tend to be a bit more pure. New equipment orders, China for China, excluding home lifts, excluding modernization, excluding retrofit, real kind of pure new equipment market. But the shape is the same, whether we go from 100 to 500, or some people argue up to 1 million, the shape is the same. It peaked in 2015, had a mild downturn, had a recovery, and a bit of a pop in 2020 as the government relaxed the previously implemented restriction measures because they were worried about the COVID impact. And the market responded rapidly to that. I'll come to the tactical kind of near term in a minute. If we look at maintenance market in China, 17% CAGR in the last decade, phenomenal. And if we look at just extending the current installations, that's effectively the forecast below there, that it results in another sort of 7.5% growth if we just continue plugging at the current 500,000, 550, 600 type thousand units per annum. And we do think that's a sustainable level if we think about 1 decade forward. We maybe differ to some commentators on that. Some suggest that it has to be structurally lower. If we go at this level and assuming some degree of replacement demand, which is going to be kicking in China at some point, then we're going to get about 12 to 14 elevators per 1,000 people in urban population. So it'll be quite high up there in terms of where, say, Hong Kong is, certainly quite a bit of Japan. But the way they build in China, the way the urban population lives, we think that's still a reasonable number as opposed to needing to be 30% lower. The modernization part of it, we think, is the most interesting end market in the whole kind of elevator world, if I could say that, for the next decade, because it has just started mimicking the new equipment market. That got to 100,000 in 2004-05, depending on whether you look at installations or orders. And now modernization is getting up to that sort of 70 to 100,000, following the 15-year gap. That is the classical modernization kind of a lifetime for elevator, and especially in China, where equipment, we're told, being used much more aggressively in terms of data that we picked up in some places in terms of numbers of starts of elevators per day in China is structurally higher than anything in Europe. We think it's really overdue, so we do forecast that modernization will grow 5 times in China in the next 10 years. So it's kind of doubling and doubling again and then growing off that base. Moving on to the but. That's the but. So a couple of charts here. So the bottom left is the Evergrande share price, and that's in red, and the blue is the broader property developers index, to put into perspective of not just one company, one stock. What we've seen is tightening since really beginning of this year, and even kind of since summer last year with the 3 red line policy, that pushed some developers closer to the line in terms of being able to service their debt. Simply put. And the really big catalyst was nearly a month ago on 23rd of September, where one of the largest developers, Evergrande, which is around 4.5% of the total Chinese construction market, reported that they potentially couldn't pay on the debt coupon of 82 something million dollars, which they then were given a 30-day grace, and that sent the whole kind of market tumbling down. And now we're ending up in this situation, or have ended up in a situation where the classical lenders are just so worried that they don't lend to anyone, or they're super cautious. So even the guys who should be receiving funding normally are not, because there's just broader concern and sentiment crisis. And the same happening from population in terms of people putting down deposits for new homes. So how has that demonstrated itself so far is, if we look at the chart top right, we see monthly China construction data where it's starts, land purchases, and completions, and you can see it in starts and land purchases that they have already started going down by double digit for 2 or 3 months, as the developers basically gone into balance sheet preservation mode. Don't buy land, don't start much new, just build, and completions are hence up substantially. In terms of in terms of what that means for going from here, it really comes down to two things. What exactly happens with Evergrande? We will learn probably soon, given that it was 23rd of September and it was a 30-day period. It's a monthly payment, so we're on 20th of October right now, so let's watch that. We do not have an official view as Credit Suisse on that. But second is what the government does. And that's what's interesting to us, is that the last kind of couple of moves from the government in China were along the lines of, let's pacify the system. The message is that Evergrande is an isolated incident. Okay, it is a large piece. It's 4%, 4.5% of the market. But it's isolated. And the message to lenders was, from a recent seminar from People's Bank of China and the lending regulator, is that let's carry on as business as usual. And then there was another piece of the kind of better guidelines on simplification or acceleration of the lending process for construction mortgage loans as well. So we think we've hit the bottom of the sentiment. We've hit the trough. And there are some signs of now kind of a bit of a recovery of that. So key to watch. And our view, if we go back on one slide to that kind of China outlook, we're expecting China new construction to be stable from here. That's what we expected basically 5 years ago, when the government said we want it to be stable. Usually if they say that, that probably will be. We expected that pre-pandemic. We didn't expect the bounce back on the back of pandemic. I think that relaxation was a little bit overdone. From here, we continue to say stable, and it does predicate on this kind of sentiment crisis they're rolling out right now, not extending that much further in terms of time. So we kind of expect that this resolves in the coming weeks, and then that kind of releases the system, because the underlying demand remains there. Coming on to themes. So we'll start with the most interesting one, the digitalization. It's new and not new. We've talked about it for a long time. There's been many elevators connected in previous generations. But really key is the full IoT connectivity, so that it's not just receiving one signal a day, it's receiving data-rich information, its ability to control the elevator remotely. That really is what we're talking about here in terms of digitalization and connectivity. We view it from two sides. One is opportunities, the other one is risks. And from opportunity side, it's a bit of a busy slide, I realize. The one side of it is the add-on revenues. So what we see in terms of monetization of connectivity, presenting it as value creation to the end user in terms of ability to view your equipment, understand its availability, uptime, usage patterns, etc., and improving the uptime, and selling that as an add-on service, which is really the mantra of large OEMs, or most of them, and actually some of the newcomers as well, which I'll come on to in a minute. The second big opportunity is the operating cost reduction. So you connect the elevator, you know a lot better what's going on with it. If it's broken down, you know exactly what's broken down, so you can go and fix it straight away, instead of having the 70% fixed on first visit rate, which is, I think, is the norm in the industry. And sometimes you don't have to go out, you can just reboot it remotely, so you've really saved a visit, which is substantial. We think the sustainable way to monetize this is the first one. We think the cost reduction part is likely to get competed away eventually. That's what we've been saying from the beginning on this, from probably two and a half years ago when we put out the first view on it. So we'd really look for monetization through add-on subscription revenues to IoT packages as the sustainable way to monetize IoT. I think the other way will eventually lead potentially to higher service margins, maybe new business models, but it'll also lead to basically value added being passed on to the customer. In terms of disruption risks, it really is kind of the second part there. It's the kind of coming in of the new players in the space, which I'll come on into in a minute. But it also is kind of a message to the supply chain and to independent service providers that we've been putting out, well, since actually Interlift 2019, is that it really is kind of digitalize or die, I dare to say, because if, as an independent service provider, you're not ready with some connectivity solution, whether own or via independent platform, then what we see from the large OEMs that is very publicly announced is that they're probably going to have 1 million lifts connected each in 3 to 4 years' time. That's a substantial chunk of the installed base. Is going to be more than half or roughly half of what they have in their maintenance bases. It will be a lot more difficult to chip away at the connected install base than a traditional. It's a completely different business model. It's a different level of interaction with the customer, with the end user, with what they look to offer. And I would say the same for the component vendors as well. The component vendors would have to be ready to have products that fit into this, that are plug and play, that are connectable, that are data rich, pre-sensors installed, etc., to remain relevant in this space. Happy to talk about the numbers in more detail, but this is really in terms of the big four, the levels of connectivity right now, and yeah, in terms of what they're targeting, this is over 50%. Related to that, we've got newcomers in the industry, which is something that we discussed a little bit last night, and I think we all concluded that this is first time for a long time. In this industry, I tried to look back and try to find when was it that you really had a disruption. I think the real kind of disruption from newcomers, and that's been not since kind of deregulation and opening up the whole thing to independent service providers. So we've got two types. We've got the service providers, so I think very well reported now, We Maintain, Uptime being one of the most kind of vocal ones. We also flagged Muska in South America, Simplify in Germany. So what you've got here is the IoT tech-driven new elevator service providers. And the model is either we just build an elevator service business from scratch, and we win by being able to offer connectivity and better service and value added through that. Or we do that as a incubation lab, demonstrate the technology, and then go to independent service providers and team up with them to take them on a digital journey and connect their maintenance base, and then globalize that. So those are kind of the two broad paths. What's interesting to us is that both are hinged on higher ASP. So neither of these so far talk about, hey, let's do elevator maintenance for half the price because we can really do it a lot cheaper with this connectivity. We're not there, at least yet, and that's very reassuring to us as kind of people who monitor the market values of elevator companies. The business proposition right now is hinged on let's increase ASP because we provide better service and then share that economics. The concerning part is that if you look at, for example, We Maintain and Uptime, they were not around 3 or 4 years ago, and yes, they've got maybe a handful of thousands of units each in their maintenance base, maybe a bit more right now. We haven't spoken to them for a little while, since probably April, May. But from 0 to 5 to 10% of the Paris install base is quite quick. So even though it's single thousands, maybe edging into double thousands, but all starting both in France and Paris. And if you look at a specific market that they've been addressing so far, they've gone from 0 to anywhere between 5 and 10% very quickly. And then the supply chain. We've got new vendors coming in outright, like Bosch Elevator Cloud. We've got some of the new offerings from existing vendors that are feeding into this IoT theme. Here really, when we look at the what's differentiating, what's new, I think there are new pure technology vendors, and what it really boils down to is who has access to data and who owns the data. Obviously everybody will say it's the customer's data in the end, but kind of the paths it goes through to that kind of analytical platform and then the implementation of any of the solutions is key for how that part of the supply chain will develop. And then moving on to next, consolidation is something that we watch very closely, given that we're obviously kind of stock market commentators, you could say. It's been also interesting to see developments on this side in this industry. It has been a while since we had any kind of large M&A, and in the last couple of years, we've had kind of 2 or 3 things. So Hitachi bought Yungtai, a Taiwanese with very large Chinese exposure elevator maker, so some consolidation there. Sort of around kind of mid-single digit market share in China that got rolled up into Hitachi. Otis announced that they're buying out Zardoya minority. Arguably doesn't make a huge amount of difference given that they own more than half already, but nevertheless a step in consolidation direction. We have obviously TKE, which ThyssenKrupp Elevator, that has changed hands from ThyssenKrupp Group to a private equity ownership in announced in 2019, closed in 2020, so we'll be watching that very closely, given that the average holding period for private equity is about 3 years. So sometime in 2023, we'll probably start hearing what their plans are for this business in terms of further ownership. And we had Toshiba Group, where there's been a lot of kind of management change and news flow at the beginning of the year. Now one of the more aggressive, very activist shareholders have taken a significant stake, according to them, Elliott, in Toshiba just literally a couple of weeks ago. And it's the, you could say, classical conglomerate. And what I see from my broader coverage, where it's not just elevators, but the likes of Siemens's and ABB's and Atlas Copco's, Sandvik's, Schneider's, Legrande's, etc., is the trend of deconglomeratization, if I can put it that way, i.e. splitting out the pure plays. So within Toshiba, the elevator and HVAC business that Kony owned already nearly 20% of is quite interesting. And then at the supply chain and ISP level, we've also seen some change, which has been maybe happening a little bit more under the radar. It's probably something that you see a lot more of and hear a lot more from your position being in the industry. For us, that's kind of not a natural stream of information, but we've been quite tuned into it. And what's interesting is that we had these changes of consolidation by Vantage and American Elevator Group on both service and component levels, and we haven't really seen much of that happening in Europe, which as always makes us wonder whether that's just a matter of time or is there something structural that is preventing that from happening. And the next would be obviously what happens in Asia, where there is already a fair bit of consolidated kind of large supplier base. And then on the final topic, not to end on a negative, raw materials and broad-based inflation. A couple of charts here. I think everybody's aware of the current situation. We had steel prices going up 2 or 3 times, depending on where you look, Europe or US. So that's anywhere between 100 and 200%. Plastics nearly doubled as well. That's the top right-hand side chart. What's happening in terms of the P&L impact of the companies I look at is that they've had the purchasing agreements with a lot of you guys or a lot of your peers that maybe prevented that P&L impact from hitting in the first half of 2021, although the obviously spot prices started going up from the end of 2020. And now it's starting to feed in. So second half of this year is kind of the crunch time for the industry, in our view. There has been a response in terms of price increases. The OEMs talk about around mid-single digit, a bit more in the US, a little bit less in Europe, a little bit less in China, but around mid-single digit price increases being pushed through from the middle of the year. That's kind of in public domain. And we're very reassured to hear about sort of similar price increases from the supply chain from your guys. And to put that into perspective, that is on the lower end of what we hear elsewhere in terms of building systems, when we think about locks, electrical systems, sanitary systems. 3 to 4% price increases is kind of very reasonable in that context. In some cases, we see price increases up to 9-10%. And this is for not materials, but industrial systems into buildings like HVAC or electrification, not talking about pure rebar or concrete, etc. So that's clearly a key development to watch. And I guess the ray of sunshine there is that we have seen stabilization in spot prices for the last 3 to 4 months. So at least we kind of got to a high level and now trending at that. That's why these charts that basically extend the spot to the end of this year and into H1 next year, or end of this year, start to come off, because we're basically assuming that's the current spot. It's been trending sideways. So come to the end of the year-on-year increases will start comping them already, and we stabilize. And that's what the current trend is pointing towards. As I was saying, we're going to do some Q&A, but I'll just conclude with a couple of remarks. And there's a few charts in the back of this presentation in the appendix where we talk a bit more about the structural attractions of this industry from our perspective, from kind of city view perspective, that I didn't put in the main presentation this time because we're more about update on the market and current situation, a bit more tactical. But this has been a great industry to be in the last decade, not just because China did what it did in that kind of with that phenomenal growth. I think the real value added and the real structural attraction in this industry is its regulatory nature of the service business, that it's unavoidable and it has to be done. and it's proven to be a key differentiator time and time again. So I've not been in this industry for nowhere near as long as many of you have been. I've followed this industry only for about 10 years, 11 years, but it was phenomenal to see it during the financial crisis in 2009, and last year the COVID situation has proven it once again. The other attraction that overlays that is the what we call ever-growing install base. It's that we look at a lot of industries like aero engines, you can look at other building systems, you look at compressors, or a lot of industrial equipment across manufacturing or buildings kind of environments. And elevators are quite unique in the sense that buildings live very long time, and elevators get modernized, and what we see so far is still a very, very low attrition rate, i.e. new buildings going in place of old buildings that already had as many elevators as a new building is very rare. So all the new installations are, virtually all the new installations are incremental to this existing base, so that install base continues to grow structurally. And that is really one of the key attractions, together with the very high generally returns and profitability across the industry. I think in terms of the digital side, we obviously have got a clear message. It has to happen. It's kind of digitalize or die. But I also want to say that the elevator industry is actually one of the early adopters of IoT. When we look from perspective of the companies we follow from construction equipment space, or again compressors, elevators really up there with them, with the newest adopters. And then in terms of the near-term headwinds on China, I think we have kind of expressed our view already. It's something to watch, I think, for the next few weeks, but I think there we kind of believe the government will do the right thing, and if needed, step in, depending on what happens with Evergrande next. That's where I wanted to conclude. Thank you all very much for listening. If I can answer any of your questions, please just feel free to reach out direct, either here in person, which is great, or over the virtual channels. You've seen my contact details, so would love to help. Thank you all.